Welcome to the Deep Dive. Today we're cutting through the noise on the Q3 fiscal 2025 earnings call for Ollie's Bargain Outlet Holdings. This one covers the quarter that ended November 1st, and really, Ollie's is pushing hard on a major growth story. The results, they certainly seem to back that up.
Oh, they absolutely crushed it. I mean, from a pure performance perspective, it doesn't get much better. You had a company that delivered a textbook beat and raise.
Right. They beat the earnings estimates and then raised their guidance for the full year.
Exactly. And yet the market's response was, well, it was immediate and surprisingly punitive. The stock took a sharp pullback on the day of the release, closing down about 4% on nearly triple the normal trading volume.
And that conflict right there, fantastic operational strength hitting a wall of investor anxiety, that's the mission of this deep dive. So let's start with the headline numbers just to set the stage for how well they actually did. Diluted and adjusted EPS came in at 75 cents. That's a massive 29.3% increase year over year.
And it comfortably beat what the street was expecting by, 2 to 4 cents? That's right. And, that earnings quality, it was supported by really solid top-line growth. Net sales hit $613.6 million. That's an 18.6% increase over last year, pretty much right in line with expectations. But the number I was watching, the real canary in the coal mine for any retailer, was the comp sales.
Agreed. And comparable store sales were up a strong 3.3%. Management was really clear that this was almost all driven by more people coming through the doors, more transactions. It just confirms that shoppers are really responding to what they're offering.
And they said that momentum started in October and was carrying right through into the holiday season. So if you just look at those numbers, in the vacuum, the stock should have been flying high.
It should have been.
The fact that it dropped so hard tells you the entire conversation has shifted. It's not about if Ollie's can execute anymore. It's now about the cost of that huge expansion and maybe whether the stock's valuation was just, a little too rich to begin with.
Okay, so let's dig into that future success piece, the engine of the bull case here. It all comes down to this accelerated growth algorithm. Management sounded incredibly confident, starting with just the sheer pace of new stores. In Q3 alone, Ollie's opened a record 32 new stores.
32. That pushed the year-to-date total to 86 openings. We're talking about an 18% growth in the store count. They're now at 645 locations.
And that's what gave them the confidence to make this huge shift in their long-term plan.
It's a monumental shift. They raised their total long-term store potential, what they call their white space target, from 1,050 locations all the way up to 1,300. That isn't just an incremental tweak. It's a fundamental reset of the company's trajectory.
So what's the driver here? What's letting them be so much more aggressive all of a sudden? It sounds like it's more than just finding empty retail space.
Oh, it absolutely is. They're benefiting from what management called an opportunistic real estate strategy. Basically, they're capitalizing on distress elsewhere in retail. Specifically, they scooped up 63 former Big Lots leases.
So they're getting into established spots.
Exactly. It lets them lock in really attractive second-generation space in high-traffic areas, instead of having to build from the ground up. And that gives them the pipeline visibility to maintain a minimum 10% annual unit growth rate for the foreseeable future.
It's interesting you mentioned the profitability of the model. We saw SG&A improve by 50 basis points, but with sales up over 18%, shouldn't that leverage have been even stronger? What's holding that back?
That is a great question, and it really gets to the immediate cost of this acceleration. They're getting great leverage on operating expenses, but they're also absorbing some new transitional costs. The big one they mentioned was about $1 million in what's called dark rent.
Dark rent, for anyone who hasn't heard that term, what exactly is it?
It just means they're paying rent on a property that is currently dark. It hasn't been opened yet, so it's not generating any revenue to offset its own cost. It's a temporary drag on the margins right now, but it's a direct investment in that future growth. It's short-term pain for long-term gain, guaranteeing that 10% unit growth.
Let's shift over to the customer side because that's where you see the real health of the model. The Ollie's Army loyalty program is now at 16.6 million members, and these members spend over 40% more per visit. That's your core strength right there.
But what's really fascinating isn't just the size, it's who is joining. New memberships were up 30% year over year, and management pointed to a really surprising shift. The fastest growing groups of new members were younger customers, 18 to 34, and maybe even more important, higher income customers, households making over $100,000.
Wow, That's a huge demographic shift for a closeout retailer. It suggests they're not just surviving, they're actively capitalizing on that trade down trend we're seeing in the macro economy.
Precisely. And it wasn't an accident. It was driven by a very intentional merchandising decision. That 3.3% comp growth we talked about was all for more transactions, but it was partially offset by a lower average ticket price, a lower AUR.
So more items per basket, but the average price of each item was down. Why would they be okay with that?
They called it a strategic price investment. They went after aggressive, low AUR deals, especially in things like consumables and basic household goods, CPG products. They did it to widen the price gap between them and traditional grocery stores. The goal is to get those new, higher-income shoppers in the door for a cheap roll of paper towels, and then hope they stick around and buy the higher-margin treasure hunt items.
That's a brilliant strategy. But to reach those younger, more digital native customers, your marketing has to change too.
Absolutely, and we're seeing a complete digital transformation there. Ollie's is actively moving away from traditional print flyers and TV ads to a data-driven digital-first strategy. They did a full media review and ended up reallocating their print budget, specifically cut out expensive postcards that were going to non-responders.
And what was the result of that bet on digital?
Immediate positive returns. Management said October was the strongest month of the quarter, even with the reduced print spending. It proves the new approach is working. They're lowering their customer acquisition cost and reducing their dependence on those old school circulars.
Okay, so if the results are great, the growth pipeline is full, and the customer strategy is working, we have to come back to the mystery. Why did the stock drop? Let's hit those investor friction points, starting with margin.
The main issue was gross margin. Even though operating margin expanded, gross margin actually went down slightly, just 10 basis points to 41.3%. This was due to higher supply chain costs and some lingering tariff expenses. Even with better merchandise margins, those outside factors kept a lid on it.
And the second point, which is arguably the biggest one, was the strain on cash flow. Free cash flow for the quarter was a negative $26 million.
And this is the absolute crux of the anxiety. That negative number wasn't from losing money. It was from them spending a ton of cash to support this massive growth. We're talking about $31 million in CapEx for the new stores, plus all the inventory needed to stock them.
So the market is basically saying, we love the 1,300 store goal, but we're worried about how you're going to fund the next 650 of them.
Precisely. The market right now is prioritizing cash conversion over a high growth multiple. When a company is funding heavy growth, if they aren't generating enough cash internally, they have to borrow it, or, worse, issue more stock, which dilutes current shareholders. The sell-off is just investors getting nervous about the capital needed to build that future.
And we should touch on their comments about consumer health, which were pretty nuanced.
Yeah, they noted that the strength they're seeing from upper middle and upper income shoppers trading down is more than making up for what they called a little bit of softness in their lowest income customers. So it seems like the value proposition is so strong that the influx of wealthier shoppers is more than covering any strain at the bottom.
Looking ahead, management did raise the outlook for the full fiscal year 2025. They raised guidance for both net sales and adjusted EPS, now expecting a range of $3.81 to $3.87. That shows a lot of confidence.
It does. And that confidence extends right into the holiday season. They guided Q4 comparable sales to a positive 2 to 3%. But, this is the important part, they explicitly said that quarter-to-date trends were already running ahead of that guidance.
So they're lowballing it, setting themselves up for another beat.
That's how it looks. It's a conservative position for the most important retail period of the year.
So what does the path look like for 2026 as they sort of digest this huge year of expansion?
The growth mandate is still in full effect. They're targeting 75 new store openings next year, which is still way above their long-term 10% algorithm. The good news for investors is they expect significant SG&A leverage in 2026. That'll come from annualizing all the new stores and from those dark rent expenses finally rolling off as the Big Lots locations open up. The goal is double-digit top-line growth and mid-teens bottom-line growth.
And of course, all of this growth needs infrastructure. They're not slowing down on supply chain investments.
That's the foundation for the whole 1,300 store plan. They're expanding their Texas distribution center to support up to 800 total stores. After that, they'll start expanding the one in Illinois. These are big-ticket, high-capex projects, but they're absolutely necessary.
And that brings us to our final segment here on the deep dive. This is not financial advice. This is purely for entertainment and discussion, looking at the market's psychological reaction to the data.
And the thesis here is pretty compelling, I think. The market punished the stock for a short-term self-inflicted cash flow problem, a problem that exists because they're investing in growth. At the same time, it completely ignored the accelerated growth story and the confirmed holiday momentum. The dip created a really interesting value opportunity.
And you mentioned you saw some noteworthy options activity.
Yeah, we saw a lot of high volume activity in the $130 call options that expire in December of next year. That suggests some sophisticated investors, the smart money, are already betting on a strong recovery through 2025.
So how do you play the immediate weakness given that strong but conservative Q4 guidance?
This is a textbook mean reversion play. Given that management basically told you Q4 comps are running ahead of guidance, that 4 to 7% drop looks like a temporary mispricing. The trade idea is to buy the $130 call spread that expires in late December. It's a very near-term bet. You're capitalizing on that dip, betting that strong holiday sales will push the stock back toward the analyst average target, which is in the mid-140s before the year is out. A quick trade on strong fundamentals overcoming temporary anxiety.
That wraps our dive into Ollie's. The key takeaway for you, the listener, is this. Ollie's is executing its growth plan perfectly, but the market has put its demand on the table. It wants proof that all the spending on future growth will turn into positive free cash flow sooner rather than later.
And that raises a really fascinating structural question for the future. They successfully pivoted to attract these younger, higher-income shoppers with CPG deals and digital ads. If that trend accelerates, do they change their whole merchandising mix to keep those new customers? Or do they stick strictly to the traditional treasure hunt closeout model? That dynamic staples versus treasures is going to define their margins for the next decade.
Fascinating stuff. We appreciate you joining us on this deep dive. Now go forth and continue your own research.